Welcome to today's webinar. We're so glad you've joined us today. At the bottom of your screen are multiple application widgets you can use. All of them are resizable and movable, so feel free to move them around to get the most out of your desktop space. To the right of the slide area is our resource list. In that list, you can download a copy of today's slide deck and check out other resources we've made available to you. We encourage you to ask questions throughout today's webcast using the Q&A widget. We'll do our best to answer those throughout the live broadcast and at the end. If we do not get to your question, or if a fuller answer is needed, we'll be following up with you later individually. Please note we do capture all questions. We're offering CPE and CTP credit for live attendance today. In order to be eligible, you must listen to the entire broadcast and answer the required amount of poll questions. We'll be sharing the poll results with you, so we encourage you to answer those as we go along to make a fuller experience of the webinar. If you qualify for the certificates, you'll find them in the widget and can download those before the webinar concludes. Connect with us on LinkedIn by clicking the icon at the bottom of the screen and following us. Check out our expert conversations on our YouTube page, where you can subscribe to watch future conversations. Answers to common technical issues are found in the Help widget. An on-demand version of today's webcast will be available tomorrow and can be accessed using the same link you used to join today. Under the Dodd-Frank Act, we're required to caution you that swaps have risks. At this time, I'd like to introduce today's speakers. Jackie Bowie is a managing partner and head of EMEA, providing guidance and strategy for the European and APAC regions. She is a member of Chatham's board of directors and our senior leadership team, and brings over 25 years of financial markets expertise to advise clients in the real estate and private equity industries. Amol Dhargalkar is a managing partner and chairman for Chatham's board of directors. He's the global head of Chatham's corporate sector and brings over 20 years of experience in derivatives, capital markets expertise to the treasury and accounting solutions that support our clients' strategies and operations. We're so glad you joined us today. We hope you enjoy the webinar.
Well, thank you all for joining us, and Jackie, thanks for being here. We're excited to share with you some of our perspectives with our semi-annual market and economic update. We know that you could have, instead of watching us, been spending some time with Jerome Powell and listening to his Humphrey Hawkins testimony in the House. We'll do our best to summarize that for all of you throughout the course of our presentation here today. You just heard Becky Miner go through some of our administrative details. I won't repeat any of this. Before we begin, though, we are required to tell you that swaps have risks, both under the Dodd-Frank Act and the MiFID disclaimer. You've learned all about Jackie and I already, so we won't bother reintroducing ourselves. And before we dive into the agenda, we're just going to do a quick introduction of Chatham for those of you that aren't as familiar with us. Chatham is a firm that exists to empower our clients to have the best possible capital markets outcomes, from financial risk management, hedging, and derivatives, all the way through capital structure and providing technology solutions that puts everything together that enables our clients to have the best insight into data to make those decisions. We're a firm that's been around for over 30 years, working with thousands of clients across the globe to enable them to have those capital markets outcomes. So with that, let's do a quick overview of our agenda. We're going to cover a handful of major topics here today. We're going to talk about the macroeconomic environment, the rate environment, everyone's favorite topic of geopolitical volatility, some of the implications that we're seeing for our clients and strategies that they've been implementing as well through some of the market-specific highlights that we're going to share. Now, I think there are some poll questions that we had also asked our audience, and I know all of these were important topics that we had heard from everyone.
Yeah, so thank you very much for those of you who answered the pre-webinar poll question. It really helps us understand where you want to focus your attention. And maybe no surprise that most of you chose the option that what you're most concerned about this year is central banks and monetary policy. So that will form the vast majority of what we'll talk about today. But there were some interesting geographical differences in that. And from my neck of the woods in Europe, certainly the participants in the UK and Europe seem to be more concerned about those geopolitical risks and how that might impact economies and financial markets this year. So again, we'll touch on that as we get through the slides.
Yeah, and that might feel even closer to home, given that there have been wars right on, in Europe, and on what feels like the doorsteps. Whereas, for those in the U.S., there's been a little bit more focus on, certainly what will happen with central bank rates, whether they'll come down anytime soon, and of course, some of the political winds are starting to pick up here in the U.S. So lots of respondents that focused on that as well. So let's go into the macroeconomic update, and we have a chart here that just talks about inflation. We really can't talk about anything until we talk about inflation. And so there are some different paths here that we're seeing in the US and the UK and the EU. So the US is the dark blue line. Just the quick look at the chart, peaked a little bit earlier, came down a little bit earlier, but we're starting to see that really flatten out. Is that something that we should be worried about or not? Even listening to Powell's testimony today, he's continuing to pound the drumbeat that the Fed's job is not done, but they are seeing meaningful progress towards it. So there's a number of reasons to be positive and hopeful on the inflation front, but you'll note that it's not quite at that 2% dashed line yet on core PCE. And so there is some real work to be done. And you wonder if this is one of those situations where the last mile is going to take the longest to complete.
Yeah, and very similar in the European market and in the UK, where we've seen this really quick decrease in inflation. Now, some of that is base effects, as we start to see the year-on-year numbers and we lose that huge energy impact that happened. And, Europe is much more reliant on importing energy, Eurozone in particular, very reliant on Russian gas. So that impact was bigger for us than it was in the US, but very similar position where, as you say, that last mile of getting inflation to target seems to be causing some issues. And certainly in terms of the data, and we'll talk about this a little bit more, what are the key areas that central banks are looking at? And one of the common themes across all of the markets is really just how tight the labour force is. And that has impact on, of course, wage growth and how that then feeds through into inflation. So there's a couple of big data outputs coming in the next few months. And as we start to talk about when central banks will feel comfortable enough that the inflation is at target or close to target, then that will be the data they'll look at to then decide if it's the right time to start cutting interest rates. Now, I think the other thing we should just quickly talk about here is really just the difference in the growth scenarios in the US versus the rest of Europe and the UK. But before we get to that, we're going to jump straight into our first poll question.
So let me read this out loud, and hopefully everyone can see this on your screen. Our first question is, how many interest rate cuts do you expect from the Fed by the end of 2024? A, the Fed will not cut rates this year. B, 1 to 2 rate cuts. C, 3 to 4 rate cuts. D, 5 to 6 rate cuts. Or E, the Fed will hike rates this year. And before anyone asks, we're trying to set the baseline of 1 cut would be considered 25 basis points. And so, this is one of the biggest questions that we've been getting from clients, and market expectations have changed so dramatically. What are some of your thoughts as you look at the environment and what you see out, what's being communicated by the Fed and even how the market's responding to that?
Yeah, and again, I think the Fed, the ECB and the Bank of England have almost been quite contrary to what the market has priced in, and they've been pushing back quite heavily in signaling to the market, don't get too excited about these rate cuts coming. But again, I think we have to highlight the difference between in the US and the rest of the world. The growth situation in the US, very, very different to what we're seeing in Europe and the UK. So I don't think it feels like the Fed is in such a rush compared to what we were seeing at the end of last year. But let's see what our audience think if the results are in.
Let's see. I think we should have the results in. And actually, we have another question here while I'm pulling up these results. And it looks like more than 2/3 of our audience is in the camp of 1 to 2 rate cuts. Interesting. Just before coming on, I looked at the market implied probabilities. It's in that one. It's more than one, less than 3. So 2 is kind of a good place to be. I really want to talk to these less than 1% of folks who responded with hike rates this year. You're not alone. Larry Summers has certainly claimed that. Apollo's chief economist Torsten Slok has said that. I don't think they've definitively said it will happen. They've said it's a possibility, and so that could be really interesting.
But what a difference from where we were sitting just at the end of 2023, where we were talking to clients who were saying they were expecting six rate cuts this year. So a really big shift in, I think, 2 things. One, the amount that the Fed will cut, but also 2, the timing of when that first cut is likely to come.
Yeah, that's right. And I think on your point earlier, Jackie, when we look at the growth picture in the U.S., it has been really, really strong, surprisingly strong. I mean, many of us probably remember the negative GDP print in the first quarter of 2022. And there was a lot of talk of recession. We'll talk about the 2s-10s spread and the inversion in the yield curve a little bit later. So, I mean, lots of recession talk. We saw layoffs in the tech sector, which people are expecting to permeate through the rest of the economy, and that just hasn't happened. And to your point, labor markets have been strong, job growth has been strong, wage growth has been moderating, which is it depends on your perspective. If your wage growth is moderating, probably not good, but generally wage growth moderating is good for the economy. We want it to be up, but not as high as has been because of inflationary impacts. But again, I mean, this is, to your point, allowing the Fed to have a lot more patience over what they do. And if they're going to make an error in one direction or another, my personal view is that they're probably more likely to err on the side of letting inflation come down and risking a recession or meaningful reduction in growth, rather than being the central bank that let inflation get away from it twice in one cycle. But the picture is a little bit different in the rest of the world. Yeah,
very different indeed. And I think one of the areas to really pick up here is the difference in the fiscal position, where in the US there's been a fair amount of fiscal largesse, you could say, and that is still, and consumers are still feeling the benefit of that. There's excess savings. U.S. consumers more likely to spend those savings, and that's keeping the economy very, very strong. Over in the UK and Europe, as you see from the slide here, a very different picture indeed. The Eurozone economy is extremely weak, really led by Germany, heavy industrial economy, very export driven, not quite registering recession numbers, but pretty much stagnation.
Right on the cusp, right?
Right on the cusp. And the UK, of course, did register an official technical recession at the end of last year. But by the time those numbers were reported, we're already out of it. So something to celebrate. But again, the picture is very similar in that it is real stagnation of growth. And, the US has much higher productivity than the UK and Europe. So more opportunity for that growth to continue. So that brings us into this real dilemma for the European Central Bank and the Bank of England, which is if inflation starts to get close to that target that we've talked about, there is more justification for rate cuts to try and stimulate the growth picture.
Yeah, that's right. By the way, I just want to note that Jackie, you said something really nice about the U.S. economy there on productivity, and it's on a recorded line, so I'll be playing that over and over and over again.
Well, I know the UK would love to have some of that productivity
Uh,
improvements for sure.
Well, maybe the answer is more AI for everybody.
Could be.
Actually, before we move on to our next slide, we do have a question here, which I think is relevant to what you were mentioning about some of the fiscal spending in the U.S. The question is, with U.S. interest expense now being the third largest government expense to Social Security and Medicare, how sustainable is it for the U.S. to keep rates at this level if it is considered to be higher for longer? I mean, really important question. We don't have all the data in front of us to say that interest expense, definitively is or will continue to be as significant as it is. But this is one of the important points of having an independent central bank, which is to say, the pressure will be there from any administration to lower interest rates. Nobody actually wants high interest rates because it can have the impact of crowding out other spending. But it is a real concern for the U.S. Is not just on an interest expense standpoint, but total debt. It is getting up there and has been pretty high for a while. One benefit for the U.S. is, as a sovereign, we were issuing debt in our own currency, and regardless of what the rating agencies have said, most of the world views U.S. debt as truly the safest benchmark risk-free rate in the world. And as rates have gone up, it's become quite attractive relative to other assets. So I think it is a very real challenge that we'll probably be speaking to over the coming years, regardless of whether rates go up or down, because just the level of debt, even with lower interest rates, means interest expense will be significant for the U.S. All right, well, let's move to, speaking of rates, the rate environment itself. I mentioned earlier the 2s-10s spread, everyone's favorite indicator of a recession. When you do the research, this is a really good indicator in the U.S. of an impending recession within, call it like 2 to 6 quarters. Sometimes as far out as, maybe 8 quarters, but generally is a really good predictor. And from the first inversion that we saw, I think we saw the first inversion, call it in summer of 22, as we were coming how COVID was starting to really be in the rearview mirror. But it has been inverted now for, like a year and a half, a little bit over a year and a half. And you can see the fluctuation. The 2-year treasury is the light blue line, so it's higher than the dark blue line. The 10-year treasury, you can see it, it's been more inverted, less inverted, but has not been so far a great predictor of a recession. But this inverted yield curve does cause a number of challenges in capital markets as well as opportunities for our clients. And so I'm going to just move to looking at some shorter term yield curves. So we've got on the left here the 3-month term SOFR forward curve. And you can see over the last 3 months, it has not materially changed. It is quite inverted, with SOFR in the low 5s right now, 530 some amount or thereabouts. 6 quarters forward, it's looking like it's going to be, 4.5, 4.6%. So about 70 basis points, 80 basis points lower with a flat curve after that. So lots of opportunities for companies to maybe term out debt using swaps in an inverted yield curve environment. But those swap rates have also increased. It wasn't that long ago that in the US, swap rates were very close to zero, sub 50 to 100 basis points. And those rates have clearly tripled, quadrupled. So, unsurprisingly, as rates have gone up, swap rates have also gone up, even with this inverted yield curve. So very real opportunities here, but different than what the normal yield curve looks like, for sure.
Yeah, and a very similar story across. So this is for the Eurozone. So a very similar situation where, we have this very much priced in for those rate cuts to come this year and next. Very much the same inversion, probably slightly steeper at the short end here. And again, a very similar position with regard to Euribor swap rates. So we had a bit of a sell-off at the end of last year into the beginning of this year. And then just like we were saying at the beginning, as the market has really had to sort of pare back its expectations for those rate cuts, we started to see just a little tick up in the 5-year Euribor swap rate. There's a question that's come in, which I'll just try and loop into this at the moment, which is if the Fed does not cut interest rates this year, does that prevent the ECB and the Bank of England from doing anything? And I guess, I'll answer, Amol, you can jump in on that question too. The central banks are very focused on their domestic economies, and whilst they will be taking into account the impact of global economic growth, etc., on their economy, they will be focused on what's happening with inflation and growth. So I don't see that being a situation directly if the Fed doesn't cut. But it actually raises quite an interesting point for the Eurozone, which is the interdependency of the economies, but the fact that we have Germany in a very different economic state to Spain, for example, and how does the central bank, take that into account? But I don't know if you have another response to that, Amol.
Yeah, I think it's I don't think we should be surprised if, frankly, other central banks move ahead of the Fed on this, given given what we're seeing right now, at least. So yeah, let's talk about the UK.
So yeah, again, very similar in the UK, slightly flatter in terms of the yield curve shape, but very similar trends. And again, the economic growth situation in the UK, as we've said, is not very positive. So the Bank of England certainly have a little bit more leeway to be cutting rates earlier to try and stimulate growth. Now, it is all subject to that inflation target. And in fact, this morning, we had the UK budget. So the Chancellor made a statement to the Commons, and there wasn't any big tax giveaways, nothing to celebrate at the moment. But, the OBR, which is the Office for Budget Responsibility, have actually said they expect UK inflation to be at that 2% level within 2 months, that was the kind of headline numbers. So if that's the case, then you could see these rate cuts start to come through by the beginning of the summer, so around June time. But just to reiterate back to the data points, that the labour force numbers and the wage growth data, both in the EU and in the UK, are the real critical things to be monitoring over the next few months.
Yeah, I think that's a great reminder for everyone of it's not the meeting that's going to be the exciting point; it's the data that's leading up to the decision. So with that, actually, let's move to our next polling question. And let me read this one out loud. This is our second one for those of you that are looking for credits. I encourage you to submit your answers to this. How are you or your organization planning to take advantage of interest rate cuts? A, more floating rate debt. B, preparing to refinance existing debt. C, expand or accelerate capital expenditures. D, restructure existing interest rate hedging positions. Or E, it's too early to prepare for rate cuts. I guess given what we were just talking about, we might get a lot of folks saying E. But rather than answer this, I think we had another question that might be worth answering here. And back to the Fed. Can the Fed do rate hike in mid-year and do rate cut towards the end of the year? Can they? Yes. Will they? It would be, surprising if that were to be the case. But it's entirely possible, to Jackie's point, of if we see the data come out and we actually continue to see elevated wage growth, which means maybe inflation isn't going to be coming down anytime soon. It's entirely possible that the less than 1% of folks on the last question we asked were right, that we'll actually see a hike before seeing cuts. And the Fed will continue to say, and Powell will continue to say, they're driven by the data. Right? It's not, they also never want to surprise the market. So unless there's a dramatic shift, we shouldn't expect a surprise rate hike or rate cut.
Yeah, I think that really goes into the whole credibility of central banks, and a decision that was a flip-flop decision like that would not be taken well by the markets at all. It would look like a kind of losing control almost. So yeah, I agree with you. Whilst they can, it would seem unlikely that they would. So.
That's right. Well, let's see. I think we've hopefully got some answers here for our polling question, and we can just move forward and see what our responses are. Very, very interesting responses here. So about a third of the audience preparing to refinance debt. We'll be talking about that a little bit, depending on your industry and asset position. That might be super attractive to maybe a little less attractive, but certainly the environment is very different in 24 than it was in 23. But another third saying it's too early to prepare for rate cuts. Maybe we talked folks off the ledge of unfortunately on this, but smattering all across the board. But those are the two most popular areas that people responded. So great. Well, let's talk about everyone's favorite topic of geopolitical volatility, politics, and war. There's a lot of that this year. And I think there's a statistic that many of us have seen, but almost half the world's population is going to the polls this year. I think India gets to put its thumb on the scale a little bit there with being the largest, most democratically elected leader in the world going to the polls. But it's not just India, of course. Hearing a lot about election in the U.S., Mexico. You look at this map on the left-hand side. Many large economies, and as well in the EU, and in theory, there's a UK election, right?
Well, it has to be called before January 2025. We have a fixed-term parliament in the UK. The Prime Minister has to decide when he's going to call. He hasn't said anything yet. If we were to try and guess and land on a date, I'd go for about the 14th of November.
Very specific.
Just putting that in there. Yeah. Not too close to the Christmas holidays after the US presidential election. But one of the things the Chancellor did do in the budget this morning was a little tax improvement on national insurance, which is our social security tax. So it'll take a while for that to feed through into the pockets, and maybe people might feel a little bit more optimistic by November.
Does he get to send a letter to everybody reminding them to, or no?
Remember, I gave you an extra £200. But yeah, I mean, I think whilst the elections and everything that's happening globally, it certainly has an impact on sentiment, and whether it will have an impact on inflation is the other question, particularly when we look at this conflict index that's on the slide here. But we do have a question in from someone on the politics, which is, would you see a divergence in rate expectations? Now, I'm reading that to say, in terms of the market's expectations, depending on whether it's a Republican or a Democratic win in Congress/White House.
I think I'm not sure that we can easily answer that question. I think it will. I think it'll largely depend, Jackie, on it's not, we tend to make a big deal of the president. Hard for the president in the U.S. to do anything. Like a president can't in the U.S. enact a change in, tax withholding rates without having Congress actually be part of it. So it might matter, who wins the presidency, who wins the Senate, who wins the House. And if they will work effectively together, that might have an impact. But the markets are going to be pricing in this expectation all along. Yeah. And even if there's a surprise on election night, what we've tended to see is that the markets will react quickly. And then, if you give it time, they'll settle down and it'll become a little bit of wait and see. Regardless of which party is in power. There are some real challenges for the U.S. economy that are coming ahead that need to be addressed.
Yeah. And I think there was another question. I'm going to try and just interpret it a little, but just on the conflict side, clearly that could have an impact on inflation. And there has been some murmurings in the markets about a reflation story. We look what's happening in the Red Sea, how that might impact supply chain and commodity costs as well. Haven't seen it come through in any inflation numbers yet, but the question is, could that change? And I think with anything around kind of war, conflict, especially in regions that are oil producing or like grain, or as we were talking about Ukraine just earlier this morning, it could have an impact on inflation. But it's one of those, it's like the unknown unknowns. So whilst this conflict index is showing a pretty concerning level, and we would expect it to have an impact on inflation if things worsen in those regions, but it's really hard to put a fine point on exactly what the impact on inflation will be in a 6-month view.
That's right. And I think we'll continue to keep an eye on this. And I think our main takeaway from this is maybe the simplest way to put this is let's not get complacent. Even if markets seem calm and steady, there are a lot of potential shocks out there that could have a short-term, medium-term, perhaps even long-term impact on capital plans, on refinancing plans, on investment strategies. That's certainly we're hearing from all of our clients that they're paying attention to these factors. So with that, let's actually talk a little bit about some of the implications that we've seen. And I know we have a number of other questions that have come in here, so we'll try to get to those as well. This slide really quickly is just about looking at what's happened to central bank rates and what's projected to happen, and those projections are changing every day. And if we incorporated the over 2/3 of folks that expected 1 to 2 rate cuts in here, we'd see something a little bit different. But we spent some time on this. I think major takeaway is everyone is expected to cut rates at some point in the next, year or so. Just how much they're expected to cut rates is going to be driven by a lot of idiosyncratic factors for those specific economies.
Yeah, and I think the timing, as we've already mentioned, is also quite important, because one of the questions was around, is there a chance that the Fed doesn't move first? And I'd say absolutely. And again, just referring back to the different growth scenarios in the different economies. But I think the other thing just to highlight here is just actually the gap between where the rates are, particularly looking at those European rates versus the US and the UK. And this is emerging as a kind of a longer term scenario of where does the natural rate of interest land. So we've had this huge increase in rates, then we've had them kind of tapering off based on the forward curve at the other side. But using the kind of emergency measure rates of the last 10 years post the financial crisis as the norm is not correct. We know that's not correct. And there certainly is an emerging view amongst economists and interest rate forecasters that the US will land on a higher kind of natural rate of interest than Europe. That will have implications for currencies, which we'll come on to in a few slides' time. But I think that's a bigger question, especially for people who are financing longer dated assets and trying to say, based on today's curve, but where do I think that long-term rate will land? And yeah, it looks like the EU is certainly going to be lower than the US.
That's what it feels like, and there's so many factors in that. But we also forget this chart doesn't go quite back far enough to show that EU was at negative interest rates, whereas in the US it was a marginal phenomenon. In the euros, for a meaningful
Negative
period
a
of
long
time.
time.
So with all the implications that come with that, we'll talk about some of those in a minute. One big area, though, that we've spent a lot of time on with our clients is interest rate caps. And I think, particularly for those that are borrowing floating in commercial real estate world, where caps tend to be required from a financing and standpoint. What are some of the takeaways on what's happened with cap pricing the last year or two?
Yeah, well, I think the chart shows here just really how much those premium costs increased for borrowers. And, deploying an interest rate cap is a very vanilla product, to satisfy a financing requirement was very much the norm through the era of those super low interest rates. And certainly a lot of borrowers came a little bit unstuck as we went through the rising rate environment in realizing just how much more expensive these interest rate caps were. So a combination of the fact that the underlying rate is higher, but also because the volatility is higher, and that is then reflected in the premium cost. Important just to highlight here in this chart that the strike rates that are chosen are different, for each market. So 5% in sterling, 3% in euros, and 4% in dollars. Again, just reflecting the difference in where those forward curves are in those different markets. But I think one of the other questions that we're trying to answer for our clients and talking about at the moment is what's the optimal term of your cap. Again, in the era of ultra low interest rates, people might have been doing 3 years. Last year, people were doing 1 to 2 year extensions, just trying to get through the hump. And now we're in this position where we're saying, okay, rates are, predicted to come back down. Should I be looking at hedging out slightly longer and using that inversion in the curve? And then you start to get into discussions about the time value of the cap and how much you're willing to pay for that, as well as, of course, the intrinsic value. So discussions about using caps, certainly still what we do every single day, but much more finessing on what's the right term of my cap structure.
That's right. And the next slide shows a little bit of data around on the US side, how the tenor, exactly your point, how the tenor has changed. We've gone from, call it 2.5 years on average to down to, 1.5, 1.25 to type of years. So exactly what you're saying, and how the strike rate as rates have gone up has increased from, we were in kind of the twos, high twos range of what strikes were, and now closer to the 4% range, again, as rates have gone up. But even a 4% cap is actually quite in the money. If you're buying one right now with, SOFR where it is at 5 and change percent. So some amount of that cap, in the US at least, is a prepayment of interest, which you're going to pay anyway. So.
Yeah, and there's when rates were rising as fast as they were in 2022, we were certainly seeing a lot of borrowers buying in the money caps and using that kind of prepayment of interest philosophy. The conversations are now turning back to if rates are falling and I'm required to hedge, I'm going to use a cap, but I'm going to try and take it as far out of the money as possible to make it as cheap. And it becomes less about the interest rate hedge itself and more about complying with the financing. The only caution I would put around that is look how much those rate expectations for cuts have changed in the last 3 or 4 months. So like everything, when rates are rising, it's difficult to make the right interest rate hedging decision. It's equally as difficult when rates are falling at the other side. So yeah, don't assume what the market is priced in will be the outcome.
Yeah, is what will actually happen.
Yeah.
Right? Yes. We've gotten actually a lot of questions on the currency side. So let us actually talk for a minute about one of the other common strategies we're seeing, particularly for multinationals, portfolio companies of sponsors, public companies, et cetera. And that continues to be the trend of trying to utilize cross-currency swaps to try to reduce cost of debt. So if you can't issue naturally in some of these currencies, we have seen a number of really interesting strategies. I'd say the 3 most popular for most multinationals have been swapping debt to yen, euro, or Swissy. Those have been the big ones, particularly where firms actually have revenue or earnings to support having synthetic debt in those locales. It might make more sense to issue natural debt in
if
those
they can.
If they can, but that's something that always has to be evaluated, one versus the other. And sometimes the quantum and the speed of being able to execute the cross-currency swap can make sense relative to going through a whole refinancing process or getting a whole new investor base up and running in Japan to be able to issue there if you've never done that before. The really interesting one on this chart that I would say I was even surprised by up until about 2 years ago was China. So we have seen a number of large multinationals swap into CNH from dollars. You can see the interest rate differential in savings is actually not that different than euro. So again, you have to be the kind of organization that has earnings in China in CNH to support that. And we have a number of questions about China specifically, and maybe I'll try to combine them into one. And there's some widely reported economic woes in China. Do you think that's going to make China less robust in standing up to some of the rhetoric and policies by the U.S.? Do we expect China issues and renewed cheap China exports to have an impact on rates, primarily in the U.S.? China is just fascinating. It's going through a fascinating journey, right? We have
lots of structural change.
Yes, and we've gone from high growth to it's still growing at 5%. It feels wrong to call that low growth, especially coming from the rest of the world. But very different than very different than what it was, and as an economy. There's been a crackdown on various forms of speculation, particularly on the real estate side in China, and there's political. It's a very different political regime, I think maybe is the best way to put it. Than we didn't even see them on the election chart a few slides ago. I think one of the trends we've seen, certainly from our clients, has been recognizing some of the challenges associated with continuing to do business in China, not necessarily exiting China, but let's say hedging their bets with operations. So a lot of nearshoring, friendshoring that we've seen, a lot of US-based industrials, for example, moving more and more operations into Mexico. And I think regardless of what happens from a political standpoint, businesses are making decisions to try to mitigate some of the risk inherent in being overly reliant on any partner, whether that's China or any other country.
Yeah, another part of the world. It will be interesting to see if this trend and kind of deploying non-dollar debt will be further amplified with that interest rate differential of that long-term natural rate that we talked about. Because for a dollar borrower that has European operations, that would make sense. And if that differential widens, even more reason to do that. But would you say that this is generally open to investment grade borrowers, and maybe the kind of cross currency, being able to access it synthetically, more difficult if you're not investment grade?
Yeah, it's definitely much easier if you're investment grade. If you're non-investment grade, you can still do it. There might be some extra bells and whistles and protections that you have to put in. And frankly, the cost may be high enough that in various market environments, the savings may not be worth pursuing net of costs, especially in this with cross currency swaps. Once you've locked into that credit charge, if you change your mind the next day, you're still paying it.
Yes.
So the effective cost of entering into them may be materially higher, but certainly on the investment grade side continues to be, I'd say, a very common part of the toolkit. And for sponsors and portfolio companies that are high yield issuers, it's something that they look at, but you really have to be thoughtful about if that's the way that you want to extend, have your banks extend credit to you.
Okay. Well, we're going to move on to our next poll question. So moving on to understanding much more about what's going to drive transactions in the next 12 to 18 months. So the question is, what will exert greatest influence on transactions in the next 12 to 18 months? Industry consolidation, access to capital and financing options, government policies, economic growth, technological advancements and digital transformation, or attractive asset valuations? That's an interesting one, attractive asset valuations. I guess everyone's got a different definition of attractive.
Depends if you're a buyer or a seller.
Yes. And it's certainly in the commercial real estate world, we've seen, a fairly big shift in valuations, but it still feels like there could be more to go, and certainly in certain parts of real estate. So I think the answers to this will be very different depending on which industry the person who's answering is sitting in.
That's right, and what the outlook is. Related to attractive asset valuations, maybe taking a step back, we have a question on U.S. equity markets and how they've performed during some of the conflicts that we have continuing, Ukraine and Russia, Israel and Palestine. And the specific question is, are you surprised that the U.S. equity markets have remained resilient in the face of some of these conflicts?
It certainly feels like they shouldn't be quite as exuberant as they are. But I mean, and this has been well documented, when you actually look at what's been driving the performance of the US equity market, it's the Magnificent Seven, right? So it hasn't been a very broad equity kind of bull market. It's been very narrow. Now, you could argue that makes it even riskier, right? Because the concentration of the performance coming from only a handful. But there are such strong fundamentals, arguably, driving those stocks. We mentioned AI and everything that comes off that with, semiconductors and chips and everything that drives them. But there certainly seems to be more commentary now that the valuations are just too high, even baking in some pretty optimistic earnings forecasts. for the next 5 years. But it's a real push-pull between the sort of sentiment side versus the fundamentals.
Yeah, it's a interesting thing because you have to really even you dig beyond that Magnificent Seven. There's in some places the fundamentals really support the valuations, and that just generally earnings continue to go up. And so, on the other hand, how can you project that all the way into the future?
Yeah.
So let's see what our audience answered on this. We've got. Let's see. Almost half have said access to capital and financing options as the greatest influence on transactions. So, when we think about the last year, especially how access to capital changed very quickly. I mean, certainly if you were, to your question earlier, if you're an investment grade credit, access to capital seems to be abundant and plentiful and I don't want to say easy, but easier.
Yeah.
But not everyone's investment grade. And depending on, whether it's asset-backed financing or high yield credit, we saw certain markets, I don't want to say shut down, but maybe go on holiday is the right term for large parts of last year. So I think the expectation is that we'll have more and more access to capital and financing options, which we'll actually talk about in just a moment here. So, all right, well, let's talk about some of these market-specific highlights and we'll talk about what's happening in capital markets more generally. And if we just take a step back, we talked about swap rates doubling, but borrowing costs have doubled to tripled, depending on who you are and what purpose you have for financing. An inverted yield curve. Markets were not meant to operate in inverted yield curves for as long as we have had an inverted yield curve. This has been a very extended period of time. We talked about that earlier. We have seen, and I think there was a question on this, will banks continue to lend or not? We have seen a pretty significant change in composition of lenders. So we have seen non-bank lenders really take a large role, and in some cases, step into the role that banks used to play. We're now seeing a little bit of that, come back, where banks and non-bank lenders, private capital, private debt providers are starting to compete for the same business. But again, non-bank lenders rising up is related to some lenders just deleveraging, getting out of certain industries, reducing their risk to certain names, certain credits. That is, we think it was only almost exactly a year ago that we had some of the massive, larger banks in the U.S. and in Europe actually go through some of the funding crises that they did. It's amazing how we were worried, and a lot of our clients were worried, would that be a contagion? Even if it wasn't contagion, it's had a really meaningful knock-on impact on everybody. So lots of other elements. One big thing that I want to mention is with credit spreads adjustments as we transition from LIBOR to SOFR. I think almost every borrower we spoke with was unhappy with the idea of, wait, I went from LIBOR plus to now I have to do SOFR plus the CSA plus a spread, and the trend over the last quarter or two has certainly been to remove that CSA adjustment at this point. So less, at least that's positive. Even if spreads are higher, at least we've gotten rid of that maybe last vestige of LIBOR.
It feels this is the first webinar I thought we would get through without mentioning LIBOR transition.
Sorry, you lost the bet.
It's an important point, but yeah, still the tale of LIBOR transition is still a topic for sure.
Yeah, and I think the other item, and we talked about negative rates in Europe, interest rate floors are here, and they haven't gone away as rates have gone up, have they?
No, I think people just paid less attention to the existence of an interest rate floor in their financing. But certainly, as you say, because European rates were negative, having a floor at 0% was just, it was common in facility agreements, and as lenders would make sure that they didn't have to pay you to borrow money from them. But as we've seen the growth in non-bank lenders, like you mentioned, they are generally issuing floating rate and are looking at their overall offering on a total return basis. So we'll be putting in place interest rate floors. And what we've seen is those floors just starting to creep up a little. Again, particularly in euros, as the expectation that rates could come down quite significantly over the next 18 months. So when those floors start to be non-zero, so 2.5%, 3%, it has a big implication for borrowers that are banking on those falling rates and getting the benefit from that. But it also has a very big implication on how you think about your hedging decisions, the existence of that non-zero floor. So again, it's not universal by any means, but it's just interesting that it's becoming a bigger topic at the moment than it was, 12 months ago.
Yeah, that's right. And I think any advice you'd have for borrowers facing, going out to market, getting financing and seeing floors in them?
Well, I guess from our survey results, we know that people are very focused on their financing options. If a borrower has lots available, certainly look to try and negotiate those floors either down or out. If you have more limited choices on where you're borrowing from, clearly you have less negotiating leverage with that. I think what the borrower should be thinking, though, is that floor has a value, right? I mean, we could price it in the derivative market very easily, and it's trying to then just understand or help them understand what the total cost of that borrowing really is once you take into the fact that that floor has value. I mean, the debt fund itself could actually take those floors and sell them on.
Monetize it, yeah.
Which they do,
Yeah.
and we help them do that. We can help them value and look at that. So yeah, it's trying to just a bit of education around what does that floor actually mean for me in reality.
Yeah, that's right. Well, we've also gotten a lot of questions around the state of commercial real estate markets, which is convenient because we have some thoughts on the state of commercial real estate markets. But we'll start here and just looking at overall deal volume and investment volume.
Yeah, and I mean, obviously 2023 was a big fall off from 22, and 22 was a fall off from 2021. And again, no surprises with that when you think about how much interest rates have increased in that time. We've had a pretty sharp price correction, but probably more to come. And we are expecting volumes to start to pick up again through 2024. It might be the back end. What we're trying to highlight, though, is that refinancing risk has not gone away. Whilst rates have come down, if you look at where that loan would have been originated, 4 or 5 years ago, compared to where it's going to be refinanced in 2024 or 2025, there is a huge gap. And there's been lots of studies on trying to measure what that funding gap is. Certainly in European real estate, it's estimated to be around 50 billion euros. And it looks like there's about 140 billion euros coming up for refinancing in commercial real estate in Europe. If you were trying to look at it from a more positive perspective, again, looking at the kind of data points, you really haven't seen the distress in the market that you would have predicted if you'd looked at the way interest rates had gone and how much asset valuations have fallen. So looking at the proportion of property loans that are under impairment, looking at average NPL ratios, and the central banks report all of this data, there just isn't the signs of distress there. Now, we could be saving it all up and it's still to come, but certainly given the environment we've been operating in, all that it's led to is a complete stagnation of transactions, but no major distress yet.
That's right. And I think for those not in the commercial real estate market, all people see on the front page of the Wall Street Journal or the FT is office, 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 people not going back to the office, and impact on that, and all kinds of fun stories about how can you convert office into housing, and in major cities around the world. But real estate is not just office, which I think is a really important to take away from this conversation. It's not, there's lots of other elements of commercial real estate that are, cash flowing super strongly and positively, growing valuations and getting stronger, data centers, logistics, et cetera. There's a lot of it.
Even residential, if you look at some of the residential areas within UK, Europe, and the US. So yeah, I think it's not to say that there's certainly more pain to come. Lenders have been provisioning, and again, you can look at that and how much they've been provisioning along the way. LTVs are lower today than they were in the financial crisis. So I'm not trying to say there's nothing to worry about, but as you say, the sector is not homogenous in terms of its income projections, valuation, and leverage. So try and decipher out where the good news is versus the bad news.
Yeah, and I think related on this, we have a question that say, do you see non-bank lenders pick up a lot of this distress, which could be yet to come? And I don't know if that means will they be the ones to fill the gap, to your point, but certainly they're starting with clean balance sheets, i.e., they have capital to deploy. A lot of capital has been raised on the private debt space, for a variety of asset categories that they might lend to. And certainly the financing from private capital tends to be more flexible, if not more expensive. But that's the trade-off. And they probably have a very significant role to play. And we even see banks partnering with private capital funds in a variety of areas where banks may have the relationship, private capital may have the capital to lend, and working together could help to fill some of that gap.
Yeah, I think it probably plays two quite different roles depending on the strategy of the debt fund. So to your point, Amol, it's filling the gap, and that could be, a mezzanine slice, it could be a pref equity slice. So where the balance sheet lender has gone from, a 60% LTV to 50, and the asset value has fallen, there's the asset's still generating good net operating income, but there's just a gap to be filled. And then I think the other side of it is maybe where the question was leading, which is, will there be portfolios of NPLs? And will these private debt providers, depending on what they're valued at, take them on and just run them off? And that's two quite different strategies, but
Yes.
They could both play a part.
That's right. And we've seen that. I mean, that's a pretty normal playbook in globally, and if there's an asset class in distress, some investor comes in.
You can always see the value.
Yes, at some price, it makes a lot of sense. Well, let's talk about some of the other implications. One thing I want to highlight is pre-issuance hedging. This is a topic that we've heard from a lot of. Again, tends to be on the more investment grade side. 10-year Treasury, when you look at the dark line, has been quite volatile. Really hard to predict if you're an issuer what rates will look like even 3, 6, 9, 12 months from now. One of the tools that a lot of issuers have continued to use in their toolkit is to create some certainty. And one common strategy is to do a laddered hedging program where you're hedging, call it a quarter of your expected issuance every quarter for the next 3 or 4 quarters, and you can get to 75 or 100% hedged. What you tend to see is, one, in a rising rate environment, of course, you'll end up on average locking in a lower rate. But it's not about the absolute level of rate. What we found is for a lot of our clients, CFOs, giving an update to the board and saying, hey, here's what our capital plans are. There's value in having some level of certainty of being able to bound what that issuance cost might look like or the issuance rate might look like. And what you can see is the light blue line here has a lot less volatility than the dark blue line, a lot less ups and downs. Again, you might win, you might lose, but it's really reducing what that potential future outcome could be.
Yeah. So I think we're moving to our final poll question. So we've talked a little bit about private capital and the role that it can play. So interested to hear from our audience to answer this question. If you've considered using private capital, what is your primary reason? Is it flexibility in deal structure? Is it because you have limited options for traditional financing? Access to specialized expertise? Speed of execution, expanding financing options, or we haven't considered private capital? And I'm sure people would like to choose more than one.
All of the above, perhaps?
So really just looking for what the primary reason is. And certainly we're seeing it across all of our client base where the consideration for private capital is more frequently in the mix than it was before.
Yeah, and while we're waiting for our audience to answer this question, we've got a few other questions on private capital as well that might be relevant here. One which came up is, do large banks put money into these debt funds and affect skirting regulations that limit banks' real estate exposure? Uh, I think it's hard to say exactly what those partnership structures
Yeah.
look like, but even some of the larger debt funds have said, we have capital and they may have relationships, and so they, as in banks, may have relationships. That's the cleanest form of partnership. But there's other structures that can be there as well, and I don't want to say that anyone's doing anything to skirt regulation, but I think there's a lot of creativity in financial markets when problems like this exist, and there's a lot of capital to solve it.
Yeah. Yeah. Shall we see if our
yeah.
answers have come in? It's almost out of time. So it looks as though many of you still are not considering private capital, but of those that are considering private capital, it's really about the flexibility in the deal structure, which really is what we're hearing as well. I think the flexibility of the deal structure combined with the speed of execution is really together one of the main reasons that we are seeing. So that was our final poll question, and we're just about up against the hour. So I think we'll leave it there to wrap up. There are quite a few questions still in the chat. We are going to go through them after the webinar wraps up, and either Amol, myself, or one of our Chatham colleagues will be back in touch, and we look forward to connecting with you then. Thanks again for joining us today.
Thank you.